Welcome to the Global View, the show where we look at ways for investors to make money beyond the ASX listed universe. I'm your host, Juliet Sarli. Well, it was an AI reality check on Wall Street overnight, with tech stocks seeing a brutal sell-off. The NASDAQ sank more than 3% at one stage, while a closely watched gauge of chipmakers slid close to 8%. It followed a 10% drop in South Korea's chipmaker-heavy Kospi index during the Asian session. The tech sell-off has pushed the NASDAQ down more than 5% from its peak at the start of the month. The Dow Jones Index was flat. The S&P 500 index was off by around 1.5%. Among the chipmakers posting heavy losses were Qualcomm down 8%, Marvell off almost 10%, and Micron, which reports after the bell on Wednesday, plummeting more than 13%. The world's most valuable company, Nvidia, dropped more than 4%, pushing its market cap below $5 trillion. It and Tesla, which sank almost 6%, were among the biggest drags on the NASDAQ outside the chip sector. Other tech heavyweights were mixed. Alphabet and Apple were lower, Microsoft rose, and software stocks like Workday and Salesforce also higher. Those shares had been sold off heavily earlier this year on some of the AI-linked fears. Elon Musk's SpaceX briefly traded below $2 trillion in market cap for the first time since its debut earlier this month, before rebounding into positive territory and closing almost 1% higher. And FedEx shares were lower despite posting quarterly earnings that topped Wall Street expectations, and said profit would grow this year, a boost for the courier's effort to simplify its business. Questions have again, though, been raised over the viability of the US-Iran peace deal after US President Trump said Iran had agreed to nuclear inspections into, quote, infinity, while Tehran said it had made no such concession in negotiations. Trump was speaking in Pennsylvania in a bid to rally political support in the Rust Belt to voters grappling with inflation. Meanwhile, the US Senate backed legislation directing President Trump to halt military action against Iran, the latest rebuke of the president from an increasingly restive Congress. Expectations for a hike from the Fed of at least 25 basis points in July are up to more than 36%, up from more than 8% a week ago, according to CME Fed Watch, while markets are pricing in a 69% chance of a hike at the September meeting, up from just 29% a week earlier. In economic data, US manufacturing activity rose again in June, but factory employment hit a 6-year low, blamed on rising operating costs related to the Middle East conflict. S&P Global said its flash manufacturing PMI increased to 55.7, the highest reading since May 2022. Treasury yields fell, with the 2-year note, which typically moves in step with Fed interest rate expectations, down 4 basis points to 4.19%. While we saw the yield on the benchmark 10-year note fall to 4.49%. And the greenback touched its highest level since November as traders cemented views that the Fed will lift interest rates this year. The Aussie dollar down more than 1% in the US session and is now trading at 69.2 US cents. Well, in commodities markets, oil prices settled 1% lower as investors kept a close watch on crude flows through the Strait of Hormuz, following signs of progress in the US-Iran peace talks. And gold prices fell as the dollar hit that 1-year high on increased expectations of a Fed hike, outweighing support from softer oil prices and progress in the peace talks. Bitcoin also continued its decline. It's now trading below $63,000 a coin. Let's get more now and join Anu Ganti from S&P Dow Jones Indices. Great to see you, Anu. Just give us a sense of what we've seen in this volatility, particularly with the lower oil price.
Yes, I mean, there's so much to unpack here. It was certainly a rough day in the markets. The S&P 500 was down over 1%, as you showed. We're down over roughly 3% for the month. So it's been a tough day so far within the tech space. Having said that, it's interesting to look at volatility right now because if you look under the hood, specifically cross-sectional volatility or dispersion has been at extreme levels for a while now. And we have an index called DSPX, which measures the market's expectations of future dispersion. And we hit roughly a few highs so far this June, which tells us that the market is continuing to price in this greater company level risk and that greater dispersion in the market. Meanwhile, overall volatility has been relatively low. Of course, we saw the VIX jump today to over 19. So that may be starting to change. So the question right now, I think, is whether this weakness in tech is a short-term blip or whether it's a sign of an ongoing rotation towards defense, towards more defensive-related sectors. And of course, we've seen the dollar strength. We saw the recent hawkish sentiment from the Fed. You just showed the probabilities increasing of a Fed rate hike, which is the next question in the background. So which sort of spooked the markets today. So we're looking ahead, of course, to tech earnings like Micron. We're looking also to the PCE inflation numbers to give some signals here of whether this is sustained weakness or not.
And when it comes to that overall inflation picture, I mean, the yield curve flattening despite those expectations, do you think the bond market's becoming more concerned about weaker growth rather than persistent inflation?
Yes, I mean, that is an excellent question to look at the yield curve right now because we've seen that flattening. We've seen greater action in the shorter end of the curve with the rise in the 2-year yields. But the question is, if we see a continued flattening, that could be a headwind for certain sectors like financials, for example. So this will be interesting to pay attention to. It'll also potentially have an impact on tech and the tech weakness that we've seen, because a lot of these companies have their cash flows out into the future. And if we discount them at a greater, higher rate, that could be a headwind for valuations. So rates are super important right now, particularly on the shorter end of the curve as well as the longer end of the curve. I think inflation will be an important indicator to drive the conditions of the rates, both on the short and on the longer end. And of course, we've seen on the macro side, we saw some geopolitical relief earlier this week. We've seen crude oil prices decline, which can potentially be a benefit for some of these sectors and some input costs. But of course, we're looking to that PCE number as well to see the impact on consumers.
Yeah, a very key one for the week. What about when it comes to the outlook for gold losing momentum? Why don't you think it's acting like a safe haven given that we still have no clear certainty from what's happening with the US-Iran peace deal?
Yes, gold has been very unusual to watch so far this year. Of course, we saw the stellar run, and then we've seen the pullback over the past couple of months. And really, it comes down to a couple of things. So one is, of course, rates again, closely intertwined with gold and the dollar, because as we've seen yields going up, inflation expectations going up, we've seen the significant dollar strength, of course, that we saw today, which, of course, has a direct impact on gold. Also, we're seeing sort of a retreat away from gold into riskier assets. And just talking about risk sentiment, if you look at our momentum index, S&P 500 momentum, we've reached historic highs. And traditionally, we used to see that momentum was very closely intertwined with growth, with the big growth names. But what we've actually seen is that the momentum index has done well independent of these growth names, which is just a sign of the risky sentiment. But of course, after a day like today, we're going to be looking ahead to see if the reverse happens and we see more defensive factors like low volatility take hold and whether that rotation will continue. And we'll see how gold does in this environment if we start to move towards a more defensive path.
So looking across what we've discussed on there, rates, currencies, commodities, and looking to equities as well, where do you see the biggest disconnect between market pricing and, I guess, economic reality at the moment?
Yes, it's certainly interesting to look at, the economy and the overall market, and there's so many different factors to disentangle. Of course, recently with the GDP figures being revised downwards, there's been some concern about weakness within consumer spending, lower business investment. So there are concerns on the economic side. I would say the other concern, of course, is international. right? We all saw the news coming out of Korea and the chip makers there and the sell-off there and sort of cascaded within the U.S. So the U.S. is certainly not operating in a vacuum right now. So international growth, overall macroeconomic growth within the U.S. and overseas will continue to potentially have an impact on U.S. markets going forward.
And we know we focus a lot as well on index performance. Do you think the biggest story, though, is what's happening below the index level in individual stocks? We touched earlier on, that big drop coming through from Micron and some of the tech players.
Absolutely. I think if you look at, dispersion under the hood, company level volatility and the spread between winning stocks and losing stocks, there's certainly a lot going on under the surface, particularly within tech, especially within the semiconductors space. And it's also been interesting to look at the breadth within the market. So if you look at the percentage of stocks that have beat the S&P 500, it was roughly 24% in May. It came down significantly from over 60% in February, right around and right before the time when the war began. So increasingly, the market has been just dominated by a handful of these semiconductor names, these chip maker names that have just driven the market downward, as we saw today. So the other thing we'll be looking ahead to, and in fact, so far June, we've started to see a broadening where more than 60% of the names were beating the index. Of course, the index has posted a loss, so it's been an easier hurdle to beat. Is whether the index performance and whether the breadth will start to broaden away from these chip makers.
Really great to chat, Anu. Enjoy your evening. Thanks so much, Anu Ganti there from S&P Dow Jones Indices. Before we go, a quick look at what we are expecting on the local market. And despite the tumble in the Aussie, despite that weakness coming through from those tech players, the S&P ASX 200 is expected to open higher by around 0.4%. That does it for the global view. Stick around. The Open coming up next.